everyone, and welcome to this evening session on how volatility can create opportunities. I'll just do a brief hello to everyone. I see all the panelists are here. It's good to have all of you here. We'll be having a quick discussion today with some of our investment specialists at Efficient Group and subsidiaries, Efficient Wealth, BIP, at Naviga, and also Efficient Private Clients. An insightful discussion on what is happening in the markets and how we are responding to it. I think we've been having or receiving a lot of questions and concerns from our clients, specifically about these uncertain times and what we're seeing happening on markets. So we decided to get the experts together. Davie is here, Davie Rood, our chief economist at Efficient Group. Dian Jansen van Rensburg, he's the managing director of Naviga Solutions. Pierre de Klerk, he's the managing director of Boutique Investment Partners. And Rian Prinsloo, he's the chief investment officer at Efficient Private Clients. My name is Francois Stoffberg, and I'll be facilitating this panel discussion. We have a couple of interesting questions that we want to address specifically today. The chat function is not working. You can unfortunately not post a question on the chat box, but you'll see at the bottom of Teams there is a Q&A button that you can click. And if you click that Q&A session, you can write us a message there, and I will answer those messages as we continue throughout the session. So I'm going to start today's session and give over to Davie for a brief, and I try to coach him that it should be brief, but yeah, we know that he always has enough to say. But Davie, please, if you can maybe just start with an economic overview in terms of some of the main things, I think geopolitics, Russia, China, maybe some monetary policy and the possibility of a recession. Please, Davie.
Okay, thank you, Francois. Thank you very much, everybody. So let me just run through a couple of things. You gave me 5 minutes starting from now. So 16:07, I'm supposed to be done. Just a very quick overview of what's going on internationally. Obviously, I think it's important to understand that the world economy was already experiencing an opening up after COVID. That is important because that resulted in a huge increase in demand globally. Apart from that, the fiscal authorities internationally stimulated the economies like there's no tomorrow. They started sending out money to their citizens in some instances, like for example in Europe. And we also, all of this was happening in an environment of exceptionally loose monetary policy. With that, I mean interest rates being very low, and central banks doing what is called quantitative easing and stuff like that. So that resulted in an upward pressure on inflation. And not that long ago, 5 months ago, we were still debating whether the current or the inflation that we then saw coming through internationally, whether that inflation was transitionary or whether it was of a more permanent nature. As it turned out, it turned out to be more permanent of nature, and that means that central banks are likely to keep on tightening monetary policy. Tightening monetary policy means that they're increasing interest rates and that they're reducing the amount of liquidity that they're pushing into the financial markets, or maybe even withdrawing some of this liquidity, called quantitative tightening. So remember the word quantitative tightening. Then we had a war in Ukraine, and the war in Ukraine, of course, exacerbated this whole thing, resulting in a substantial increase in commodity prices, especially the energy prices, but also food prices, especially grain prices. And remember, when you talk about energy, like oil price as an example, there are many related commodity prices going up in price as well, like for example fertilizer prices. So that went up very sharply, pushing inflation even higher, and that is the reason then why central banks globally are tightening monetary policy quite aggressively now, because initially we had inflation, it proved itself to be more permanent of nature, and now we have this additional inflationary pressure coming from the war in Ukraine, and the central banks are tightening monetary policy quite aggressively in some instances. We've already seen Americans tightening, and some other countries like the Brits already tightened monetary policy, and a couple of other ones, and the European Central Bank probably going to tighten monetary policy as well. Now, that is the reason, that is the main reason why central banks, that's the main reason why the financial markets have been under some pressure, because of the tightening of monetary policy. Remember, the tightening of monetary policy simply means that that central banks are trying to force somebody to take the pain of rising commodity prices as an example, and inevitably pain means slower economic growth. So the world financial markets are reacting to that, and the world financial markets are trying to discount the impact of this tighter monetary policy on basically on their own bottom line, their profitability. Will they remain profitable, and to what extent? And we as asset managers all over the world, we are trying to do exactly the same and try to determine which one of the companies will come through this whole thing the best, and what the impact will be on their bottom lines, because we use, amongst others, things like, for example, earnings and earnings potential to determine whether we want to invest in a certain company or not. So that's where the world finds itself at the moment. It is quite volatile. It's at uncertain times. Clearly, world economic growth is slowing down. It is possible that we could see some countries dipping into recession. More analysts are talking about the possible recession in the United States. I think for the world economy in total, we're probably not going to see the world economy contracting this year, but next year we may see one or two bigger economies like the Americans, for example, dipping into recession. I can also just mention the sooner you start tightening monetary policy, the quicker the pain is over. Also keep in mind is that financial markets always try to look into the future, and it is untrue to say that if the economy goes into a recession, as an example, that the equity market necessarily fall in tandem with that. In fact, equity markets or financial markets are far cleverer than that. In financial markets, try to look into the future, and you will start seeing financial markets picking up again, even before the economy actually goes into a recession, because they look through all of this. One or two comments still, and that is the conflict, the geopolitics in Central Europe. My view on that is that will go on for a very long time. I'm talking about years there, which is likely to result in commodity prices coming down a bit, but remaining quite high, relatively elevated. And I'm also very concerned about famine in some countries in the world. So that's something I'm quite concerned about. As far as South Africa is concerned, we all know that we have some certain challenges in South Africa, but one of the highlights certainly is that the South African Reserve Bank is independent. We just saw the most recent inflation data coming out, 6.5%, the inflation rate, the most recent that we have, and the Reserve Bank is likely going to keep on tightening monetary policy. Fortunately for us, the South African Reserve Bank is a little bit ahead of some other central banks, like, for example, the Americans and certainly the Europeans. And the sooner you start with tightening monetary policy, and the bigger steps you take in tightening monetary policy, the less you eventually have to do. So fortunately, I think the Reserve Bank in South Africa is in a good position, or rather made the right decisions. But still, economic growth in South Africa is likely to remain quite pedestrian for quite a long period of time. And that's mostly because of a government and the wrong macroeconomic policies that we have currently. How's that for 5-6 minutes, Francois?
That was beautiful. Luckily we're recording this because now we have evidence that you can do it quicker. No, I'm just kidding. Thank you very much, Davi. And just on that, as you say correctly, there is a lot of volatility. Global growth is slowing down. There are a lot of noise about recessions on the horizon. But I like your comment about how financial markets look through and look into the future. And that's exactly what we're here to discuss, is those opportunities in the financial markets, and of course, how to manage the volatility. So I want to bring in Dian to talk about one of the ways, or how we construct portfolios in these uncertain and volatile times to protect our investors. If Dian, please, over to you.
Thanks, Francois. You should be able to see my screen. So before retirement, the ideal portfolio is a balanced portfolio that invests in different asset classes that provide you exposure to cash, bonds, equity, and property. And these market drawdowns is now opportunity to add more equities to one's portfolio. So add equities at a cheaper price. But when you come to retirement, that's slightly different, as one needs to sell units to fund the income. So at Efficient, we use the silo approach, where we divide the assets between a short, medium, and long-term silo. And the short-term silo invests in money market type of funds that provide stability and the income to our clients. But we also need to invest in a medium and long-term silo with some equity exposure. Because if you look at the table here, money markets is stable. The lowest 1 year return was only 3%, the highest return 12%. But on average, it was only about 7.5% return. But as you go down and you add more equities to a portfolio, you can see the annual return increases from 7.5% for money market to 13% for equities. But the volatility also increases. Equities can be down by 32% over a year, but it can also be up by 62% for a year. And that's why we allocate that equity exposure to a medium and long-term silo, because it can be volatile over short term, but over the long term, as you can see, equities outperform money market quite comfortably. There's quite a significant difference between equities, which is the red line, and the money market, which is the blue line. And we had similar market conditions in 2020 with COVID. Markets fell about 25% during COVID. And this silo approach worked very well for our clients because they didn't have to sell equities at a loss. They would only withdraw their income from that yellow line, which is similar to money market funds, which is very stable. And only once equities recovered at the end of the year, we rebalanced the portfolio and took some equity exposure back into the income funds. And we've been very active the last 2 years in this silo approach, where as markets went up, you can see the red dots. Every time we took some profit, took that profit back into the income funds to make sure that our clients got enough assets in the short-term silo to provide their income. The most recent rebalance was in January of this year. Last year, we had a fantastic year in equity markets, almost 30% up last year. We didn't know Russia will happen in January of this year. But fortunately, we did rebalance all our clients' portfolios in January. So our clients got enough income in their short-term silo for the next couple of years, and that will allow equities in the medium and long-term silo to recover. So there's sufficient time in our portfolios for equities to recover and provide above inflation returns. So I'd like to hand it over to Pierre de Klerk, our MD from Boutique Investment Partners, just to quickly explain how we manage each of these silos. So Pierre, I'll hand it over to you.
Thanks, Dion. And the main topic I really want to cover is the one of style diversification. Diversification is the only real free lunch in investments or in saving, as we all know, and that operates at different levels. So don't only buy one share, buy a number of shares, because some of them will go up and some will go down. Same at the industry level. Don't concentrate your investments only in one industry, but spread it across the economic industries because they will behave differently through the economic cycle. And at the portfolio level, what is particularly important to us is to invest with funds or managers that follow different investment approaches or styles like value, momentum, quality and growth, and size, which refers to managers that focus on smaller companies. And the reason why it's important is, and that's illustrated schematically or on the right-hand side, that these styles perform at different points in time and in different points of the economic cycle. And we had very good examples of that in the last 2 years when the COVID crisis happened. Quality companies was the better performing style. They protected portfolios. When aggressive monetary stimulus followed, that was good for growth shares. And now that inflation is the topical matter, it is good for value shares because value is a style that benefits from higher inflation, higher increases in interest rates. Because it's quite difficult to pinpoint or perfectly time these points in the market where rotations happen that favor these different styles, what we advocate is to build portfolios that have representation of managers and funds covering all these styles. And we believe that gives you the best portfolio robustness and the smoothest ride for your portfolio. And that's why we build the portfolios that Dion was referring to and all our multi-manager portfolios in the group in this way. To reflect and to incorporate all the styles to give us that most smooth return profile of the portfolio that we can engineer. Thanks, Dion. Thanks, Francois. I'll also speak to this one. Sorry, it's the next one for me. And this, I've spoken about styles already, but another one is the aspect of size of managers. And we do believe smaller boutique managers have a style advantage. So we blend those with the bigger managers that obviously have the deeper pockets, the better systems, or the kind of the more extensive systems, the bigger teams. So we think there's benefit in all of that. Have some exposure to large managers. They bring particular benefits, but have some exposure to smaller boutiques that are unconstrained by size. and very nimble. And lastly, also incorporate passive investments or smart beta or factor investments, because they are typically much cheaper, but they can deliver in a very smart or very efficient way the beta and the factor exposures that you require. And there we use names like Satrix, Core Shares, and NetGroup, and you can see the other brands that we use. So apart from style, there's also in the size spectrum and in the spectrum of active versus passive management, particular aspects that one can emphasize in portfolios, and we blend it together to really form portfolios that are as robust as they can be, and as cost efficient and optimized as they can be. Thank you.
Thanks, Pierre. Just before I give over to Riaan, just to touch on some of the global markets, I think we can agree, and that's what we're trying to discuss today, is that the world doesn't look healthy. Markets are uncertain. There is a lot of uncertainty, a lot of volatility, but by using something like the silo approach, you can get yourself through it. You don't have to realize those losses. And just, well done on the team for taking those profits at the right time, it would see, so that now we don't have to sell out of the equity positions. You can give the markets time to recover. And then later, when we reach all-time highs again, when we've seen ourselves through, if there is a recession, see ourselves through the recession, and then make use of these all-time highs to fill up the equity silos again. So thanks for that. I think that's already answering a lot of my questions as well. Riaan, maybe over to you from a global market perspective, if you can maybe weigh in and give us some background in terms of this setup, equities, and how this volatility can actually create some good buying opportunities.
Thanks, Francois. You should be able to see my screen. Am I correct?
I can, thank you.
Great. Thanks for the time. Yes, quickly on global markets, it's been quite a rough ride, as most of the other presenters have said. I just took some shots of what has been in the media this morning, and you can understand why investors are so nervous. On Market Watch, which is a very popular Wall Street Journal sister company, saying that it's the worst start to the year since 1932 in the S&P 500. And from CNN, their fear index is at very low levels, signaling extreme fear. So you can sort of understand that. And also, I think if you take a quick trip around the world and just look at some of the headlines, we saw massive inflation out of the US. And also we had record of low unemployment. Unemployment in the US now at about 3.6%, with a lot of Fed governors coming out saying we need unemployment closer to 5% for a longer period of time before we can do anything on inflation. And people don't like to hear those sort of things. They don't like to hear that, listen, I might lose my job or whatever the case may be. And then also US households are quite in good shape, which is actually a bad thing, because that means they can feel inflation for longer. That's the concern, at least. And they've only just now started to spend their savings, and the odds of recession, as Davy has increased. Although it's not a base case, most companies and most investment banks out there have the odds of a recession between 20 and 40% in the next 12 to 18 months. So it's not their base case, but obviously that's not what a media magazine also will print. Just quickly then in Europe, Europe's in a bit of a better position than the United States, because Europe didn't spend as much on stimulus, which means that there's not as much demand fueling inflation. It's mainly the supply shock from the Ukraine war, as Davy mentioned. PMIs are holding. We think they can trend lower. And as I said, inflation more supply driven. And then the sort of the third area is China is typically a big growth engine in the world. And what we're seeing in China now is growth is coming under pressure from lockdowns. We saw massive lockdowns in the likes of Shanghai and Beijing this year. Regulatory risks, at least they appear to be abating. And then also these markets are quite cheap, which means that equities are still quite attractive for us and for South African investors. Of course, what happens in China has a big impact on the South African market as well. What all of this means is Federal Reserves are trying to raise interest rates. They're trying to get that sort of Goldilocks scenario where they move interest rates not high enough to be restrictive, but also not to be accommodative. That's very hard to do if you're in an environment where there's a lot of supply shocks. Most likely in the United States, they believe that the neutral rate is somewhere between 2 and 3%. In the European Union and in England, they believe it's below that, between 1 and 2%. And that's sort of where we are now. That's the big driver, is where where is interest rates going to go? That's going to drive global asset classes over the shorter term. But I think what's important, and that's sort of my key message, is we don't think that we're out of the secular bull market. These are all transitory issues. You know, I think the word transitory, when Jerome Powell started to use it, he meant months. Now we know he means a year or so. But these are still shorter term issues. Supply chain issues will be resolved. Energy prices will be resolved. In fact, we are starting to see a lot of infrastructure spend in Europe as they ramp up and try to become more self-sufficient. Yes, at the same time, they are going to fire up some coal-powered power stations, etc. But there's this urgency, and that's actually more positive in the longer term. In the US, the consumer is still in a strong space. So we don't think that this sort of secular bull market that started about a couple of years ago, that's done yet. And that to us means that, as Dion and Pierre also mentioned, we don't want to be selling growth assets when you don't have to. We think that it makes sense to have a good financial plan, but you can't start reducing your equity exposure. We never took inflation really in account when we spoke about market drawdowns and so on, and the S&P is down around 22% year to date. But if you add inflation, it's down almost 30%. So that's quite a big drawdown. That's your typical drawdown in a recessionary environment. And there's no indication that this is going to be a deep recession. So it's becoming a bit more binary. We are trading around it. I think in the portfolios, we think oil prices are going to be longer or higher for longer. So we're trading around that in the portfolios. We've recently sold some of our oil exposure. Oil prices came back. We'll most likely start adding again in the near future. Geopolitical risk is rising. So in the defense contractors and in that space, there's opportunities that we are identifying. And then also interest rates are rising, which means there's opportunities for us in companies that benefit from that, in some of your more smaller regional banks, in some of your life insurance companies, especially those that don't own a big asset management division or alike that reduces that market beta. We're seeing a lot of opportunities in that space. And then growth is going to be scarcer. That creates volatility, yes, but also it means that companies can buy each other. It creates opportunity for companies to take market share. We see in our portfolio of companies that they've been quite active in buying some of their lesser well-positioned competitors, etc. And that's all positive for longer term growth, because now you invested in a bigger company and they bought assets at a good price. We also use our cash quite tactically. So yes, we will continue to try and add value and use this volatility to our advantage.
Thank you very much. Thanks, Riaan. Yeah, so there is a lot of uncertainty. There is volatility. Markets are down. I don't think anyone can argue that. But with the correct strategy, like the silo approach Dion went into quite some detail with, you can protect your investment and, of course, then your retirement if you're retired, because you're not realizing these losses. You're not selling your equity positions, your growth portfolios, if you want to call it that. And what you're saying now, Riaan, is that it's not only that your investment is protected through the correct strategy, but you can even use this volatility to increase your positions in these valuable companies that we are keeping close eye on. Like Pierre also said, that's why we have these different managers and these different strategies, so that we can take advantage in these growth silos for our clients going forward.
I mean, take an example. Amazon is buying back their own stock for the first time in almost a decade. That is fantastic news, because you don't have to buy more Amazon stock. They're doing that for you.
Doing it for you, yeah. I like that. Thank you very much.
Can I just add something to that? Global stock to stock correlations are very low, and that's a very good market for active stock pickers or active managers. That means although the market might be down in totality, there's actually stocks going up and stocks going down, which is very positive for managers that can pick out the better ones.
That's very clever. Thank you, Pierre. I want to quickly give over to Dion again, because I really think we want to drive home this point, is to remain invested, and how things like timing the market can be very risky. And so Dion, please, over to you. I think you have some more to share. Thanks.
Yeah, thanks. So human nature is, when markets fall, you would just want to sell your equities. But the best strategy is actually to do nothing. We know it's extremely difficult, but the best thing is to do nothing. And I've got 2 slides to indicate why. So one is, as you can see here, over short term, there's a high probability that one can lose capital on equities. But the longer you keep equities in your portfolio, longer than 3 years or 5 years and longer, there's a 0% probability that you'll lose capital on equities. This is based on long-term historic data. So the longer you keep equities portfolio, the less probability that you can lose capital on equities. And that's why we use the silo approach. The equities is only within the long-term component for 5 years and longer, because 5 years is enough time for equities to deliver growth. And the second one is that market timing is extremely risky. This is a study done by Coronation over 6,000 days. And on average for this period, markets returned 15%. Just by missing the 25 best days out of those 6,000 days, the return reduced by 50%, so from 15 to 8%. If one missed the 75 best days out of 6,000 days, the return would have been 0. And we never know when those best 25, 50 or 70 days will happen. And most of the time, actually, those best days happen at the bottom of a market or when the news is extremely negative. So one can never know when these best days will happen. The best strategy is to do nothing and rather stay invested and make sure that you've got sufficient assets over short to medium term for your income needs or emergency needs, and don't touch your equity component in your portfolio.
I like that. Thank you, Dion. I think that the point is quite clear, and I like that analogy. Human nature is when you see red, you run. And but in markets, when our clients, or well, when clients in general try to do that, try to time the market, run out, and then try to buy back in when it's the bottom, trying to time the market like that, as you've shown, it actually hurts your investment considerably. And usually, what the research has also shown is that you can never make up those losses, unfortunately. So I think that the golden rule is remain invested. The market does reward those who are patient. I think there's a few more minutes. I didn't see any questions. We have some questions that I'll quickly address. Maybe while I'm looking at the questions, Rian, you did quickly touch on China and that they are showing some form of return to well, maybe not former glory, but there is some growth at least to be expected. Is there something else that we're still missing that you guys want to touch on in terms of maybe some of the South African equities? Pierre, I know you wanted to touch on that maybe, or some of the bonds, because I think a lot of people have questions on that. So maybe over to you first, Pierre, and then I can take the question.
Yeah, thanks. If Dion can maybe bring up the slide about the equity upside. I think the point to make is we're quite lucky in South Africa because our valuations of our share market and our bond market, for that matter, is cheaper than most of the global opportunities. So one wants to invest globally for a portion of your portfolio because there's obviously many more opportunities, but at least we have in South Africa a very good valuation starting point. And what this graph shows, and this is from Coronation, but other managers show similar graphs, is that they experience or gauge that there is very high percentage upside embedded in their portfolios currently. And if you look at the lines, that is the subsequent returns over 3 years and 2 years that they have delivered post these points of upside. So this is reflective of the SA market. We have a good valuation starting point. And the reason why our market is cheaper relative to the US and other developed markets is because pre-COVID, we had 5 or 6 or 7 years where the SA market basically flatlined while they were going up. So although all the markets globally went up since the bottom in 2020, and now they've come off a bit, we're still in a better valuation position in SA because we had those kind of years of returns that we missed out pre-COVID. So I think there's a positive story about SA equities from a valuation starting point. And on the bond side, our 10-year bonds or longer-term bonds yield almost double digits, 9.5%, and that's still a positive 4 or 5% above inflation currently, whereas if you compare that to US bonds currently probably yielding -4 or 5% in real terms after inflation, because their 10-year bond yields are 3.5 and their inflation is currently 8 or above. you get a negative real return. So we're really lucky in SA that we can capture good bond yield returns, and we have good equity valuations. So I think there's a good prognosis for the SA portion of our portfolios.
Sorry, just to add here, this is slightly outdated, this chart, but you can add 0.75% yield onto all these rates. So money market currently at 5%, flexible income funds above 7%, and bonds is more than 10% currently. So the yields in South Africa is extremely attractive compared to our inflation, also to the rest of the world.
Thank you, Dion. Thanks, Pierre. I'm going to end the session there formally. There are a couple of questions, but I'll address those. If you would like to stay, we can quickly address them. But thank you for the session, and thank you for your time, everyone. Have a great day. Okay, great. Just there were some questions. I'll maybe address them and then you can just add if you want to, guys. One of the anonymous attendees asked if one has money available for a shorter period of time, should one stay in the money market? I don't know if someone wants to address that. Should I stay in the money market? I think it
yes. So 6 months and shorter in money market. Longer than 6 months, you can go into flexible income funds that can deliver more than 7% yield. But for less than 6 months, rather stay in money market.
Great. That was actually part of the question as well in terms of the period. So thanks, Dion. I think that's spot on. So there's a question here from Leon. So I can relax when seeing this current big reduction in my high equity life annuity portfolios.
Yeah.
I think that's exactly what we're trying to say. You can relax if you are well. If you're one of our clients, if you are in the silo approach, then yes, you can.
Can I make a comment there, Francois?
Please do, Davi.
Remember, there are risks in the world, and there are risks that you can do something about it, and risks that you can't do anything about. Now, the risk that you can do something about is that you have to. Your biggest risk is to decide who you want to do business with, and I would like to think that you've decided to do business with us because obviously we are good. So that is your single biggest risk out there, because there are a lot of people out there that just not a bunch of crooks out there that's going to steal your money or mismanage your money, whatever the case may be. That's your biggest risk. Your second, but you can do something about that. Your second risk is to make sure that you have the right products and you have the right structures and all that. And that's part of our job. We try to put you in the right products and the right kind of structures, and to make sure that we mitigate your risk or manage your portfolio according to whatever risk profile you have. And then the third kind of risk is market risk. And that's something that you simply have to live with. Once you've addressed those two first issues, the institutional risk, you've fixed that, you've managed that, your structural risk and product risk, you've managed that. Then you simply have to sit back and live it out, because the financial markets go up and down. That's the nature of the beast. That's why we structure the products and the structures in such a manner that it fits with your specific risk profile. And then we go and sit back and wait for the waves to come, because we build a boat and there will be ups and downs. That's the nature of the beast. Relax. And you haven't realized any losses if you just stay in the boat. You only get wet if you jump out of the boat. Just stay in the boat. The waves come and go and whatever. Just make sure the boat is safe. And that's what we believe we've done. So no, do not get out, because the moment you get out, you realize your losses.
Great. Thanks, Davi. Zander, as a two-part question, the second part is staying invested seems to be a good strategy, meaning it's also advisable to keep investing consistently. And I think we absolutely agree. And that's what Rian tried to express, is that if you are in a position to continue investing, yes, continue to, the English term is dollar cost average, to bring down your entry price, which is always a good idea. The second part is, are we, meaning in South Africa, in a better position to avoid a possible recession compared to someone like the United States? I don't know if someone wants to take that.
Yeah. I want to quickly answer that one as well. Okay, remember, there are many variables. I think there's the Reserve Bank question thrown in there as well. The South African Reserve Bank, I think, is that the one from Zander?
That's it, exactly.
Okay, so the South African Reserve Bank is very much independent. I think the Reserve Bank started acting before the Federal Reserve of the United States. And for that reason, I believe that the Reserve Bank can actually relax a little bit more, because they more or less where they should be in terms of monetary policy. The Federal Reserve, they're a little bit behind, and that's where they started taking big steps now, because they've been left behind. They so-called behind the curve, what the economists say. But that's not the only things. It's not only monetary policy that determines economic growth. There are many other factors. But from a monetary policy point of view, the South African Reserve Bank is doing a very good job.
Great. Thanks, Davy. There are two more questions. SA property market prospects in the next few years. Who will be brave enough?
I'll take that, Francois.
I thought maybe so. Thanks, Pierre.
Yeah, I think our house view is neutral on SA property. I think most property managers expect to return at least double-digit returns or close to that. So I think comparable to bond returns probably. But it's good to use an active manager because I think they need to be selective at the sector level. The prognosis for office space is maybe not that good. Retail is maybe also under a bit of pressure currently, but other sectors like logistics, self-storage and so forth, has been more robust. So yeah, I don't think there's going to be a collapsing undershoot in the performance of property. A lot of the kind of the structural issues in the property sector has been addressed in previous years. So yeah, I think one can make kind of bond-like returns from it.
Thank you very much, Pierre. I think there's one final question that I can also try to address, or let's see if one of you wants to. How safe is it to invest bulk in foreign currency at the moment, or is a conservative investment better? So I think it's a currency. Yes.
Yeah, I will take that one. It depends on the idea of the investment. So the rand is a very volatile currency. In a week that nothing happens, the rand can move 3 or 4%. Yeah. And then in longer periods of time, you can find that the rand actually does nothing. So investing in a currency is typically, I don't think you should use the word invest. I think that if you want to invest in bulk offshore, and if you intend to stay in South Africa, it makes sense to have a portion of your growth assets, and your financial advisor will be able to help you with that. But a portion of your growth assets should be offshore because there's a lot of opportunities there. So that, as Pierre mentioned, the South African market is quite cheap. So a portion of your growth assets should also be in South Africa. And then a big portion of your income generating assets makes sense to have that in South Africa as well, because you're going to draw from that. And as I mentioned, with the volatility of the currency, you don't typically want that offshore. Yes, bond yields have ticked up a bit, but I don't think they're there. It's still a lot more, our local yields are still a lot more attractive to me, at least.
Great. Thank you, everyone. I think that's all the questions as well. Thank you for joining us. Thank you, panelists. It was very informative. Have a good day, everyone. Goodbye.
Thank you.
Thank you. Bye-bye.